Okay, good day everyone. I'm Ed Martinez, I'm head of CRL Premium, and with me today are our experts, Ms. April Tan and Mr. Juanis Barredo.
Hi.
Good afternoon, ma'am
Good
and sir.
afternoon.
Okay, so Sir Juanis, how's the market?
Well, we didn't do too good today. More markets have been coming back down towards the supportive area, and today we did get a crack of major support. We saw some pressure from the U.S. Last night, and it was because of that we saw some heavier selling coming into it. As a result, support was broken. What the charts are showing is that the selling has not abated yet.
Okay.
And we have seen some foreign fund flows that have continued to remain into the selling side. And they've been hammering particularly the banking sector the heaviest. And so far the retreat into that sector also managed to be able to push the index back below the previous low. And we've not seen any reversal patterns as of yet, so that means the trends may likely continue. But there is evidence of oversold conditions, so somewhere in between we do expect a bit of a counter rally first.
That support is the 6923 level.
That's right. Yeah.
And we've been talking about breaking that level ever since. What do you think is causing this? Meaning, I'm sure when markets correct this way, people are trying to price in something.
What triggered the latest sell-off was really the disappointing inflation for the month of August. Okay, so that marked the third month in a row where inflation exceeded expectations, and it reached 6.4%, which is really high, and that kind of surprised everybody. So it created some sort of a panic in people that inflation was getting out of control, and I guess expectations were becoming more negative. And after that, you saw, first of all, the 10-year bond rate, which was stabilizing, go up again, and the peso, which was also stabilizing below 54, depreciate. So those were the factors that were responsible for the trigger of the sell-off in the stock market. And of course, last week we had an inflation number. The good news is it was finally within expectations, but then again it still continued to accelerate. So it was kind of a lukewarm number. It wasn't bad, but it wasn't good either. So I guess that said, there wasn't any reason for people to think that we've seen the worst. That's why we're still seeing a lot of people staying on the sidelines. One of the reasons also why the market is down is because of the Fed tightening. Okay, and that has made emerging markets less attractive to global investors, because right now there seems to be a desynchronized tightening. So you're seeing the U.S. being one of the strongest economies right now. Therefore, the Fed is
tightening.
They're tightening, whereas other economies are not doing the same. So what is happening is that U.S. dollar is strengthening. Rates on U.S. or dollar papers are going up. So you're seeing funds flow out of EMs or emerging markets and going back to the U.S. and that's also causing some weakness in the Philippines. And what I just like to point out is, the Philippines has an inflation problem, whereas other EMs don't. And also, of course, our peso is weakening because of the growing current account deficit, whereas you have other countries that don't have that. Or they have current account deficits, but it's not going up the way that ours is. So, if I were a foreign fund manager and I compare EM1 to, say, EM Philippines, of course, I would want to sell Philippines more than the other emerging markets, which doesn't have similar problems.
So, Sir Juanis, the market broke down, right? So when do we expect the next support to be?
Well, I have a little bit of a picture of the market, and if you can see the illustration we're looking at right now, the index had rested on major support just last couple of days ago, and this was a major support which been generated since 2013, and it has broken that particular level now with the trend line being broken. And given the context of that, we look next to where the next levels of support will be, and those two previous lows we had is standing first at 6,500, and there's a slightly deeper one which is at 6,250. But I think 6,500 should be the more viable place that should try to hold this market up for the meantime. So maybe we can do is we can look at the scenario back in history where something similar had taken place. Back in 2008, the Philippine Stock Exchange Index was also in the same condition, where it rallied from support and fell back into that area, and it just happened to be able to break that support shelf. And I have an illustration here which shows exactly what happened during that period, where you have a situation where a breakdown condition took place and the market fell down relatively fast. After that, what followed after that sharp decline was that it leveled off in a very horizontal type of movement, and it stayed there for about 5 or 6 months before trying to be able to resuscitate itself. What was nice about this is it was the final blow that the market was waiting for, and after that sell-off, the opportunity to buy came pretty much right after that condition. So I hope that something similar is coming in after this market attempts to scale back to the last leg of this particular correction.
We are comparing 2008, where we had the global financial crisis, and now, Ms. April, are the conditions the same as before?
Well, I don't think it's the same in the sense that at the time we had a global problem, as you've said, global financial crisis. So there was a leverage issue in the U.S., which was, they talk about systemic risk. There was a systemic risk at the time, and the magnitude of the leverage was significant. A lot of subprime loans, banks had low capital levels relative to the size of debts that they were extending. Remember the derivatives, like they don't even know who owned what, and because of the derivatives, they were just lending to everybody because they were thinking that the insurance companies were insuring them anyway, so they just sold derivatives of derivatives and all of that. So that was the situation before, but because of all the regulations that came about post-global financial crisis, we don't have that.